Well, I'd like to welcome everyone today to Outlook 2023. This is our annual conference where we share insights and perspectives about the year ahead. We're delighted that you are joining us today, and we have a special guest speaker who I will introduce shortly. As a few reminders, just want to share that we are recording our conversation today so that you can view that later, or we'll also have the presentation available as a copy if you want to look at some of the slides that are being presented. So keep that in mind. And also, as we go through this presentation, you're welcome to submit questions. We are trying something new this time. We're having simultaneous events go on where during this webinar, if you're joining us online, you'll be able to present through the chat box, the Q&A box. We also have live events in Naples and Sarasota, Florida. So folks attending those events are welcome to submit questions as well. And we really look forward to your feedback and input. Now on to Outlook 2023. First, we want to share good news. Planning Alternatives is having a birthday. We are turning 40 years old next month, and it's a great year to celebrate the history of the firm, the longevity of the relationships that we've had with you, and really the continued focus on our independent, objective advice and guidance that serves your best interest. That's how the firm was founded, and that's our commitment, and it will always remain intact. We're thriving as a firm. The one caveat is that we're still waiting to get into our Michigan office. We have a temporary office across the street. And as many of you have experienced building projects and different levels of project management, we too have hit lots of potholes along the way getting our project done, but we're looking forward to moving in soon, and we'll be hosting a open house celebration at our Michigan office and invite everyone that can attend to join us and stop by and see our new space. I'm joining our conference today from our Naples office, and so it's been exciting just to see our firm continue to grow as our clients relocate to different parts of the country, as we meet new clients, as we work with families and connect relatives of existing clients who are located throughout the country. We find that we have a lot of interaction with people through many mediums. So we're looking forward to spending time with you. We have 24 people on our team. For anyone's looking for an update, we have 8 CFPs, 3 MBAs, 2 JDs, 1 CFA, 1 CDFA, and many other professional advisors and team members working on professional designations. So we focus on our financial planning needs for you and your family, helping you build your portfolio investment strategy using a thoughtful, risk-managed approach, and work with your professional team members to make sure that you're taken care of as a whole. And we always, you are the center. So, and we've even asked you as you registered for this webinar, what's on your mind? We always want to listen to you. We always focus on what your priorities are. 39% of you in the registration survey said, I am concerned about continued market volatility. 36% said, what about recession? This seems to be a big storm cloud that's looming. 25% said inflation is a concern. So thank you for your feedback. We'll definitely focus on that. And as we continue to navigate these uncertain times and prepare for another unpredictable year, we're always looking and reviewing our best practices, the solutions that we provide to you. And one of the things that we do is being completely independent is make sure that we're working with excellent research partners. And one of those partners that we worked with for many years is a company, Bank Credit Analyst, which was founded in 1949. They are an investment research firm. Their head office is located in Montreal, and they have offices in London, New York, San Francisco, Hong Kong, Sydney, Cape Town, and Sao Paulo. And so a well-established firm that we've relied on for independent research has been very productive over the years as in our partnership. And we're delighted, and I'm delighted to introduce our guest speaker, Garry Evans. And you saw him on the registration page. Yes, Garry has 2 R's in his name, no misspelling, but Garry is joining us from Montreal. and he is BCA's chief strategist for global asset allocation. Garry was the managing director and global head of equity strategies at HSBC and editor of Euromoney magazine. He has a master's in Asian studies from Cambridge and undertook postgraduate studies in economics at Kyoto University. So Garry, welcome. Thank you so much for joining us. As we've asked our clients what's on their mind, and the number one thing is volatility in financial markets. If we could just start at a high level, what are the main components that are creating or that we should be aware of if there's volatility in financial markets from your view?
Oh, great. Well, thank you very much for the introduction, Nathan, and for the invitation to be here. So what I will do is to share my screen. It's often easier to have a look at some pictures, some charts to help you go through what I'm saying. So we've clearly, I think, had a very difficult period for markets. I mean, last year, both equities and bonds gave a negative return. And ultimately, what this comes down to is central banks. They have been raising rates, as we'll see in a second. This last year was the second most aggressive Fed tightening cycle in history. And our view is that that's likely to continue, that the market is pricing in that the Fed will be cutting rates in the second half. Our view is that inflation is not going to come down quickly enough for them to do that. So I think the bottom line, and the argument that explains that we're likely to see continued volatility, is that we see fairly clear signs now that growth is slowing, that the US economy and the global economy are entering recession. We shouldn't be too scared about recessions. They're a healthy thing, and they're not great if you get laid off, but they're a healthy way of cleaning the excesses from the economy, which allows us to have a period of long-term healthy growth. And slowing growth, unfortunately, is bad for risk assets like equities. But the problem we have at the moment is that if growth were to surprise on the upside, if we were to see actually the economy be more resilient than we're expecting, that wouldn't be good for equities either. It simply means that the Fed would have to raise rates more because they don't want strong growth. It's inflationary. And we think, therefore, that the market hasn't fully priced in that bad news. We've obviously seen quite a strong rally in risk assets from October. It looks like a classic bear market rally. So for now, for the next 6 months at least, we think that there's more downside. As we've seen the last couple of days, the market's not pricing that bad news in. But recessions tend to be relatively short-lived, 10 months on average. Stock market typically bottoms about 4 months before the end of the recession. So that would say that we've probably got a nice opportunity, perhaps in the second half, maybe in the fourth quarter, to be going back into equities again. But I don't think so yet. So I would really emphasize, if you take one chart away from today's presentation, it would be this one here. So the green line here is what the markets are pricing in the Fed will do. We have Fed fund futures. You can see it through the options. And you can see there that the market is saying the Fed will take rates currently 4.4 to 4.25 up to 4.9, probably by around March. The green line here, as I mentioned, this is what the futures are pricing in the Fed will do. So peaks at 4.9, and in the second half, 100 basis points of cuts. So we end the year actually at 3.8, 3.9. The Fed, the brown line, is what the Fed's Summary of Economic Predictions says. And they have the rates going to 5 to 5.25, so another 1 percentage point from here. Also, probably in the first half, they only give this number annually, but they're not cutting. And the latest FOMC minutes emphasize not a single member of the FOMC thinks that rates will be cut in the second half. So that big gap, I think, is the key thing that's going to drive volatility going forward. So the market still thinks we have a Fed put option, that every time growth slows, the first signs of the stock market falling, don't worry, the Fed will jump in and bail us out. But that is not what the Fed is saying. If you look, for example, I pulled out a quote here from the last FOMC press conference in December, where Powell is saying, we need a sustained period of below trend growth. And this is not just in the US, the ECB, and we would argue that European growth is actually rather weaker than US growth. Lagarde, who's at Davos at the moment, said the same thing there. Interest rates will have to raise significantly at a steady pace. We need them to be sufficiently restrictive, etc. So that, I think, is what is not priced into the markets. So the problem I see is with inflation. And that was a question that quite rightly a lot of your clients are worried about. Inflation is coming down. There's no doubt whatsoever about that. But the question is how quickly it's going to come down to the Fed's target, which is 2%. And what we've seen recently, you can see from this, I hope you're seeing an underlying inflation page here. Shout if you're not. But what you're seeing is that goods prices are coming down. And the very obvious reason for that is during the pandemic in 2020, 2021, we were all stuck at home, maybe not so much in Florida, but most of the world, we couldn't go out. So we stayed at home, we bought new computers, we bought a new house, we bought furniture for the houses, etc. And since last year, lockdowns have ended, people are going back on vacation again. The supply disruptions on goods have eased. And so we've seen goods prices coming down. And this is the year-on-year number. The last 4 months, we've actually seen declines month on month in goods inflation. But there's a couple of problems here. First of all, services. Now we're going back on vacation, airfares are going up, hotels prices are going up. People weren't going to the doctor for regular routine surgery. They're doing that again. Services prices are going up. So the Fed is worried about that. The second issue which concerns the Fed is that we still have a very tight labor market. Unemployment in the US is 3.5%. You have to go back to the 1950s to find a time when it was lower than that. There's, as I'm sure many of you who run businesses are aware, still a shortage of labor. If you look at surveys of small businesses, their reply that their most common problem is they can't find enough staff. There's not the supply to meet the demand for labor. And you can see that on the chart on the left. Simple number to remember is that there are 1.7 times the number of job openings currently as there are unemployed people. And although there are the first signs that the economy is slowing, that is not showing through in employment statistics. Every week we get the initial unemployment claims number. It came out this morning. It again was very low, historical low levels. We're not seeing people net being laid off. And the problem with this is that when you have such a tight labor market, you've got wage pressures. And if you look at the right-hand chart here, you can see the green line, which is our favorite measure of wage growth, is still running at over 6%. So that's a problem for the Fed. They essentially need to see the labor market tightness ease before they're going to feel comfortable that inflation is really killed. Now, at the same time, we're starting to see signs that growth is slowing. It's a little patchy at the moment. The best indicators of where we are today with the economy are the ISM in the US, both the manufacturing and services ISM, globally, the PMIs, the purchasing managers indexes. 50 is the dividing line between the economy growing and the economy weakening. And you can see that in every major region, we've just fallen below 50. We're not at recessionary levels yet, as you can see from this chart from the pandemic, and it's the same with previous recessions. Typically, you get these numbers go below 40. But the new orders component of both the manufacturing and the services ISM in the US, and the new orders tends to lead the headline number, has absolutely collapsed in the last month or two. Why is this happening? Well, a lot of the growth that we saw was just that there were massive amounts of liquidity put into the economy during the pandemic. If you look at the right-hand chart, for example, the second panel is probably the better one. M2 money supply growth, particularly in the US, soared, was higher than it even got in the housing bubble in 2006, 2007. And now with the Fed raising rates, liquidity is being sucked out. And that is something that typically slows the economy. Why is that happening? I mentioned it earlier, but the chart makes it clear. So the left-hand chart here is the various Fed tightening cycles since the 1970s. The red line is the current one, with the futures, what the market believes the Fed will do. So you can see this is quite clearly the second most aggressive tightening cycle in history. Only 1980, which was the second wave of Paul Volcker tightening, and we'll come back to that in a second, that was the only time when the monetary tightening has been more aggressive than this. So it'd be very surprising if with monetary policy this tight, this aggressive, you didn't see some signs of the economy slowing. Now, it's happening already quite clearly in the most interest rate sensitive parts of the economy and in housing. Housing is not very big. Residential investment's only about 5% of GDP. But you can see there that the survey of house builders' confidence has collapsed. The number of new homes that are being built but haven't been sold yet has jumped. The numbers on housing already look really bad. So the interesting question will come this year will be when we start to see signs that unemployment is rising. I mentioned it's at 3.5%. The Fed believes it'll get to 4.5% by the end of this year. So let's say they're right and unemployment goes up to 4%. Inflation's going to come down, even service inflation. There's some technical issues with that. Rents, for example, will start to come down. Early signs that's happening already. So let's suppose by mid-year, June, July, August, we've got unemployment 4%. Let's say inflation has come down also to 4% for the sake of round numbers. Is that going to be enough to allow the Fed to cut rates? That's what the market is pricing in. We don't think it is. There's a couple of reasons for that. The first is the Fed has a dual mandate. Inflation target is 2%, and unemployment. They don't have an official target, but they believe the neutral level of unemployment, the economics term is the NIRU, the non-accelerating inflationary rate of unemployment, so the right level, is also 4. So if we're at 4 on both unemployment and inflation, that's still double their inflation target at the unemployment target. So it's only when those two cross over, when they're missing their unemployment target by more than their inflation target, will they feel happy about cutting rates? They will eventually if the economy slows, as I believe, but not yet. And what's worth remembering about the Fed is there's a very strong institutional memory of the mistakes they made in the 1970s. Jay Powell, Fed chair, does not want to be seen as the second Arthur Burns, who was the Fed chair during the 70s until 78. And you can see what happened then was that after the oil embargo by OPEC in late 73, inflation picked up very sharply, but growth then fell. And the Fed cut rates in the second half of 74. And inflation never fell below 5%, a green line on the right-hand axis. And that set the stage for the stagflation that we saw in the 78, 79 period. The Fed doesn't want to make that mistake again. So I think the analogy to use, it's like if you have a fire, the firemen come along, fire department comes along, they put water or a chemical on the fire, and they keep on doing that even until it looks like the fire has gone out, because often there'll be some little burning embers there, which if you stop the extinguishing too quickly, it'll flare up again. The Fed sees inflation being like that. So our view is that we are most likely heading for recession. I think I managed to skip over a chart earlier. Yeah, this chart, which is quite important. So the checklist of indicators that we found useful in the past to tell you about the risk of recession. Pretty much all of these are flashing a red warning signal at the moment. And I won't go through all of them, but the one that has worked the best, I'm sure everyone knows this, but it's worth emphasizing, is the shape of the yield curve. So simply what that means is 10-year bond yields versus 2-year bond yields. And when the 2-year is above the 10-year, and today it's the most above it that it's been in 40 years, roughly since when Planning Alternatives was founded, that has been a perfect indicator of recession. So it's forecast every recession in the past 70 years. The last time it gave a false signal, the yield curve inverted, but there was no recession, was 1965. So that's giving a very clear signal of recession at the moment. So that's all very well. But, as you pointed out, Nathan, recession was one of the biggest worries your clients have. Some people say this is the best forecast recession ever. If you look at surveys of economists, 3/4 of them are also forecasting recession. So, the way that markets work is even if something bad happens, can't it be priced in already? And isn't, for example, investor sentiment already very, very weak? And certainly if you look at surveys, and we put this left-hand chart together from a number of useful indicators on sentiment. We look, for example, at the number of put options on the S&P 500 versus the number of call options. So when there's lots of puts versus calls, that tells you people are worried about the downside. There's a survey many of you, I'm sure, are familiar with, of the American Association of Individual Investors. Every week since the 1950s, they've been asking retail investors, do you think the stock market's going up or down the next 6 months? Many more people now say it's going down than up. So pessimism is out there, no doubt about it. A few things I would say about that, though, however, pessimism is not enough to cause a rebound in markets. If you look at the global financial crisis in 2007 to 2009, if you'd have invested based on sentiment being very negative, you'd have been buying stocks in April 2008, September 2008. The market didn't bottom until March 2009. The second problem is that, yes, people sound pessimistic, but have they actually moved their portfolios in a pessimistic way? And I think many of you on the call may be in this camp. My PA account is similar. I'm sort of bearish, but have I really de-risked my account? Probably not. And if you look at the right-hand chart, there's a monthly survey from the same AAII where they ask people, what's your portfolio look like? And people have moved a little bit out of stocks and into cash, but nothing like as much as they normally do in a recession. So there's not the capitulation there yet. So maybe the consensus is bearish. I don't know. None of us know what the consensus is. We don't have access to the biggest macro hedge funds, which are the marginal driver of markets. But what we can look at is valuations in stock markets. That's the one number that captures everyone's views. And stocks are expensive. The forward PE on the S&P 500 is around 18 times currently. And if you look back in history, you can see the average is 16 times. We typically bottom at sort of 12, 14, something like that. This stock market sell-off that we had last year, the lowest level for PEs was 16.5. Now, there's been an excuse in recent years, well, maybe multiples are high simply because bond yields have been so low. It's the Tina argument. There is no alternative to buying equities. But if you look at the relationship between equity valuations and bond valuations, so what strategists like me tend to look at is the equity risk premium. So how much more are you being rewarded for owning equities relative to bonds? Now, technically, we calculate this using the earnings yield, which is simply 1 divided by the price to earnings ratio, and subtract that from that, the real yield, the inflation adjusted yield on bonds. And so what you can see currently is that the premium is the lowest. So your excess reward for owning equities relative to bonds is the lowest it's been since 2008. Now, those numbers are also, those are based on still rather optimistic forecasts for earnings. Obviously, we're looking at forward PE, so we need to know what are the analysts forecasting. And this shows you the bottom-up consensus amongst Wall Street analysts for earnings for 2021, 22, 23. And you can see, particularly in Europe, the numbers have not yet been revised down at all. It looks like Europe is in a recession, but the 2023 estimate is significantly higher than it was 12 months ago. And in the US, it's been revised down a bit. I think that's mostly down to the strong dollar. Analysts know how to model the impact of strong currencies on earnings. But even in the case of the US, analysts are still forecasting the gap between the brown and the green line is about 5% growth in earnings this year. If we have a recession, that is not what happens. And you can see from the right-hand chart that even in a mild recession, the S&P 500 earnings have typically fallen 20 to 25%. Analysts are forecasting plus 5%. So this table, I'm afraid, is going to scare you. What we're currently pricing into markets, the S&P 500 is about 3,900 today. That's that 5% earnings growth that I mentioned, and 18 times earnings. That's a very optimistic scenario. So I would say, let's not be too gloomy here. Let's assume earnings decline by 10%. And the PE falls back to where it typically is in a recession, say 14 to 15 times. So it's not necessarily my forecast, it's just a mechanical calculation. We're talking about a fair value or a calculated value for the S&P of 3,000 compared to 3,900 today. Now, that sounds a scary number. That would be 37% down from the peak. 37% is the average peak to trough decline in the S&P 500 in recessions. So that wouldn't really be all that surprising at all. So where could I be wrong? Where could we get upside surprises? Well, I think it's true that the US economy is looking quite resilient. We've still seen consumption be relatively good. The forecast for Q4 GDP growth, which we get in another week or so, I guess, for a good number. And one of the things causing that is that we have a lot of savings left over in the US. So on the left-hand chart here, the black dotted line is household savings relative to what would have happened if there hadn't been a pandemic. So savings typically increase every year, but they increased dramatically in 2020, 2021. Big stimulus checks, a lot of people were stuck at home, couldn't spend money, and that peaked at about 2.5 trillion. And over the last 18 months, households have used about 1 trillion of that, but they have 1.5 trillion left. That's 7 to 8% of GDP. And although real wages are now falling, so wages are not keeping up with inflation, sales, consumption, retail sales have not been too bad because people have been spending these savings. So that could keep growth going, but I'm not sure this is a positive for risk assets. As I mentioned earlier, the Fed needs to see a slacker labor market. They need to see that pressure come off wages. What we're seeing at the moment, this is a little bit of economics jargon, but the right-hand side is what economists call the Beveridge curve. It's actually not that complicated. It's simply the relationship between the unemployment rate along the x-axis and job vacancies along the y-axis. And we're seeing at the minute a lot of news about people being laid off. Microsoft yesterday, Amazon last week. And what normally happens is as the vacancy rate declines, you can see in previous recessions, unemployment picks up. The problem at the moment is that we have such a high vacancy rate that those people being laid off are very quickly reabsorbed by companies that are short of staff. If you were a software engineer at Twitter and you got laid off, I can tell you there's lots of people around the world who would love to offer you a job. So the Fed is not seeing the labor market slacken at the pace that it really wants. The last macro point I'll make is on China. And we had a genuine surprise in China in December, where Xi Jinping, he's an autocrat, he can do what he likes, scrapped their draconian zero COVID policy. And that clearly will eventually cause a reopening of China. I wouldn't say it's happening yet because you've had this huge spike in cases. Epidemiologists think there'll be another wave. That's typically how COVID has worked, another wave in April, May. But by the summer, we will see Chinese consumers going out and spending. The problem, however, is that there are other things that are wrong in China. The first is that the driver of Chinese growth in the past couple of decades has been credit growth. So if you look at the left-hand chart, the green dotted line here is the growth of public sector lending. And you can see that is starting to slow down. They are very worried about allowing another bubble in the housing market in China. So the stimulus they've done was quite half-hearted. And in the private sector, we've seen very weak demand growth. And it's worth emphasizing just how important credit growth is in China. You can see this volatility of credit has been absolutely coordinated with the growth in the Chinese economy. The second problem for China is that holding Chinese growth up in the last couple of years was exports. All of those laptops and furniture, the consumer durable goods that we were buying that I talked about earlier, they all came from China. What we're doing now is spending money on services. China does not export services. That's going to drag the Chinese economy down as well. And one of the things worth remembering about China is it's very dependent on the property market. They've had this huge bubble. The bubble in Chinese property is in the process of bursting. If you look at the data currently, new house starts in China are down 40% year on year. House prices are now falling year on year. And you cannot overestimate how vital property is for the Chinese economy. It's 10% of house building is 10% of the economy. I mentioned earlier, it's only 5% in the US. It's 2/3 of household wealth versus 1/4 in the US. So I think that housing market is going to drag things down. And China, therefore, is not going to be the engine of growth. What Chinese will spend money on is consumer goods. who makes the goods that Chinese consumers spend money on? It's mostly Chinese companies. So there might be some themes to pick up on if you're a theme type investor. Casinos in Macau, often owned by US casino companies, will benefit. Luxury good makers will benefit. But for most of the rest of the world, what we sell to China are commodities, which goes into property, and capital goods, which also used to build houses and to build infrastructure. I don't see that rebounding very much yet. So I might just pause then, Nathan, to see if you've had any Q&A coming on the macro story, because I want now to apply what I said, our view of the economy, to therefore a bit more practically where a portfolio should be positioned at the moment.
Sure. Thank you, Gary. So one of the questions, it's on the international theme. We hear various aspects of analysis in different parts of the world about probability of recession or not. What do you see as the economic consequences of the continued war between Russia and the Ukraine, and the ripple effect? Is that contained economically, or is that still a major X factor?
Yeah, so we have a geopolitical service. I mean, their view is that we will eventually see a ceasefire between Russia and Ukraine, but not anytime soon. There is no real incentive for the Russians to offer a ceasefire when they haven't achieved any of their objectives. And the Ukrainians have, if anything, taken back some land. So why would they agree to a ceasefire that would mean that they need to give up the Donbass and or Crimea? So that won't happen yet. The direct impact of the war, as long as it doesn't spill outside of Ukraine, is going to be relatively limited. Where it has had a big impact has been on energy prices in Europe. And this has eased recently. You can see we had a massive spike in natural gas prices, in electricity prices in Europe last year. But for a couple of reasons, those prices have come down. One is very simply the winter has been particularly mild in Europe. I was talking to a client in Switzerland yesterday. They had 70 degrees on New Year's Day. It should be 30 degrees at this time of year. Now, it's just turned cold this week, but nonetheless, you haven't had the same demand for heating that you've had before. But secondly, the authorities did a good job last year of building up inventories of natural gas. It's going to be a lot harder this year for them to do that. And the reason for that is now there is a significantly restricted supply of Russian natural gas to Europe. And the particular issue is going to be over oil, where from December, the European Union has banned or embargoed imports of Russian oil. That will be tightened again further in February. And so our view is that we are going to see significantly higher oil prices. It's also worth remembering, if you look at those two charts, that although these prices have come down a lot, they're still very high compared to where they were in 2020, 2021. I mean, the price of electricity in Europe has trebled or quadrupled. And you can see in North America that is absolutely not the case. I'm lucky living in Montreal, that in the province of Quebec, almost all of our electricity is hydro. I tell you, my electricity bill has not changed at all. My daughter lives in the UK, in London. Her electricity bill trebled in December. And that's despite the fact the government has a cap on electricity bills. So I do think this is going to be something of a problem still going forward for European consumers. But that's the biggest impact, I think, of the war in Ukraine. And it could be, I might just jump on to what I was going to say about oil, because that I think is potentially the biggest implication of this. That if you look at the two charts on the right here, we have a quite tight supply situation in oil. Inventories, both for crude and gasoline, are at the bottom end of their 5-year ranges. We've seen only a very slow pickup in North American shale oil production last year. One of the problems here is that ESG is having a big impact on the banks. They don't want to lend to the oil producers anymore. And so despite a big rise in the oil price last year, we didn't see more money going in and an increase in the number of oil rigs out there, for example. The situation in Russia, as I explained it earlier, Russia is not going to have buyers for some of its oil starting in February. And we think that Russia is going to have to reduce the total amount it produces. You can't just keep on producing oil if no one's buying it. You've got to put the oil somewhere. So they'll actually have to close down some of the wells. And that will take about 2 million barrels a day, we think, out of production. Total global supply is almost exactly 100 million barrels a day. So that'll increase by decrease production by 2%. Why that's important is we think that means that the Brent crude oil price will get back to $115 this year. It's currently about 85, if I remember rightly. That is both inflationary, but also particularly since the rise in oil price will not be because of strong demand, but because of supply constraints, that could dampen economic activity as well. So the oil price is definitely something that you need to keep a pretty close eye on at the moment.
Thank you, Gary. Another question relates to the US dollar. So many people are, as you mentioned, making travel plans and getting back to their wish list of maybe going to other countries. What's your take on the US dollar as it relates to its strength as a global currency?
Yeah. So, I mean, certainly last year it was a big boon for travel. I was in Italy in the summer, and there were a lot of American tourists there, but enjoying the cheap prices. Sadly, I'm paid in Canadian dollars, which haven't done quite so well. You know, Canadian dollar tends to be linked to the oil price. I mean, what is true about the US dollar is that it's extremely expensive. And one of the ways that people calculate the value of currencies is versus purchasing power parity, which simply says if prices in the US were the same as prices in the rest of the world, you know, that should be at zero. And on this basis, back in October, the US dollar looked about 40% overvalued. We've had something like a 10% decline in the dollar since then. It still looks very overvalued. So the question that currency strategists are asking themselves at the moment is, you know, we had big run up in the dollar last year. It's down 10%. Is that just a sort of technical correction in a dollar bull market, or is this the beginning of a new dollar bear market? And we're going to see, you know, the point I should have made on this chart is that a currency can be well away from the PPP for quite a long time, but in history, it's always mean reverted back to that in the end. So our view is still that there's probably one more leg up for the dollar, and there's a couple of reasons for that. The first is that when you have a recession, you can see from the recessions over the past 50 years or so, that the dollar typically appreciates. And the reason for that is relatively simple, that the US economy is the most resilient. Economies like particularly the emerging markets, but also Europe and Japan are much more cyclical and more volatile than the US economy. And the US dollar is a safe haven. US investor flows are the biggest in the world. When there's a recession, people typically bring their money back home. The second issue comes down to what central banks were going to do. So I already showed you right at the beginning, I said that was the one chart to follow. One of the things that drives currencies are relative interest rates. So at the moment, and you need to look at this in real terms, adjusted by inflation. At the minute, US real and 2-year rates is probably the thing to look at, are much higher than real rates in the rest of the world. And a lot of that comes down to the fact that the Fed was very hawkish last year. It raised rates before, and you can see from the black lines on this chart, the Fed was raising rates and to a higher level than rates in the rest of the world. And so, you know, even in nominal short terms, the US rates are now the highest in the world. What matters, obviously, looking forward is what will central banks do? And what the market thinks they will do is sort of priced in. So you have to think about these dotted lines and say, do you think that each of these central banks will do more or less than the market's priced in? So the black line, the one I showed you earlier, the Fed goes to just under 5 and then cuts rates in the second half. The market believes that the other central banks will be more hawkish. So look at the red line, the ECB will be raising rates more rapidly than the Fed in the first half and then won't cut. Same story for the Bank of England, same story for the Reserve Bank of Australia. And our view would be that the European economy, the UK economy, Australian economy are not robust enough to take this degree of rate hikes. So we think the Fed will end up doing more than the market's pricing in, and the rest of the world will do less. And that interest rate differential compared to what the market's pricing in is the thing to look at. So bottom line, we think what we've had so far is probably just a technical correction in the dollar. and we've got a little bit of upside. So, hopefully that will happen by the summer, so that the dollar purchasing power in Italy is going to still look interesting by the time that you'll do your trip to Milan to buy your luxury goods this year.
Thank you. I'll just tee up the next segment, which is where you're going to be discussing what your investment views are. Many of you on the call today may think, wow, there's still some turbulence expected in financial markets, and as Garry mentioned, that it's a year of two halves, where BCASC in the first half of the year is experiencing some challenges, the second half of the year having potential for recovery and gains. And it may be very natural to say, well, maybe the sky might be falling, so we should just stop investing. We should get out of all of our strategies. And the answer is no. This is really a question, an issue that occurs many, many times over various market cycles. And our job in protecting and managing your funds is to make sure that we have a risk management strategy in place, which is based upon the principle of diversification. And Garry will speak to that shortly. And it's always important to have, if you think about three buckets that are representative of your needs in a time perspective, a short, intermediate, and long-term bucket for how you view your money and your financial needs. And we always talk with you about that as we build your financial plan and review your upcoming cash needs. And in fact, our specific strategy around cash distribution is set up for anyone who's drawing off their portfolio to always be having funds sent to you from a stable location within the portfolio. So we carve out a number of months of cash and make sure we're monitoring that for you. So just to tee that up, Garry, as we've always talked about asset allocation, which means spreading your investments into different categories. What's your view of a wise asset allocation in the environment that we're in?
Yeah, no, absolutely. I mean, diversification is the only free lunch out there, is often what people talk about in allocation. I've occasionally last year, when things look terrible, had clients saying, well, shouldn't we just have 100% in cash? Well, you should never do something like that. And in the long run, it's worth emphasizing, when I showed you the chart earlier, but the return from equities is significantly better than return from fixed income. So you remember I showed you that equity risk premium. I told you it's rather low compared to history, but nonetheless, probably worth emphasizing what that message is, that you are still going to get, in the long run, and you can argue about how long we mean by long run, 4.5% more from equities than you're going to get from bonds. And so if you're a long-term investor, particularly if you're a younger investor, you're not too scared about having some drawdowns. You definitely don't want to have too much in fixed income in the long run. Having said that, however, if we're heading for a recession, and we are going to see S&P goes to 500, 500 goes to 3,000, as I suggested earlier, where are the places to hedge that? And one of the things, and it's sort of becoming a little bit priced into markets, is that 2 years ago, I'd have told you not to own any US Treasuries at all. They were yielding less than 1%. They didn't offer a hedge at all. But where we are today is that, typically in a recession, you find that bond yields decline. If you look at the relationship between the last rate hike by the Fed and the peak in 10-year bond yields, the average is 1 month. So if the Fed raises rates for the last time in March, you might expect to see bond yields rise a little bit further. They got to 4.2 in October last year. But the range is plus to minus 4. So if it turns out that October was the peak, it wouldn't be super surprising compared to history. So what drives the return from bonds ultimately is whether the Fed surprises on the upside or the downside. What our bond strategists like to talk about as the page 25, as the golden rule of bond investing. So the green line on the right-hand chart is that golden rule. So that is what the Fed did compared to what the futures market was pricing in it would do 12 months earlier. So when the green line is below zero, it means the Fed was more hawkish than the market expected, and above zero, more dovish. So typically in the last 20 years, the Fed has turned out to be more dovish. And obviously in the past year, 12 months ago, the market believed the Fed would raise rates twice last year, and they did 400 basis points, 4% in the end. So that question is possible if what I said earlier was right, that the Fed does a little bit more. So maybe the negative surprise is 100. It's important is to think about, from a portfolio point of view, does adding treasuries to your portfolio make sense? So what this table simply shows you is the return that you'll get from treasuries. Just look at the US line, total return, so the interest plus the change, depending on what level of yield we are at in 12 months' time. So the worst case scenario, we have a big reacceleration of inflation. The Fed is even more hawkish than I think. I wouldn't say that bond yields would go to more than 4.5. And there's some good economic reasons I perhaps won't go into today to think of that. So the worst case, you're going to lose 4% on your treasury portfolio. Let's suppose we have a recession and bond yields go, even if they only get back to where they were at the beginning of last year, which was 2%. Now, remember, they were at 0.5 in 2020. So, I would say 1.5 to 2 is perfectly reasonable, even in a mild recession. You're going to get something like, close to 15 to 20% return from US treasuries. So that seems to be an interesting place to be in a portfolio at the moment. One thing that we published a report on last week, which is quite interesting, I didn't put the chart in here, maybe I should have done, was to look at which asset classes perform in different investment regimes. And when we look at those regimes, it's typically thinking about inflation versus growth. So you have 4 quadrants, if you like. So what we had last year was rising inflation, declining growth. And that's the worst part of the cycle. In that regime, only cash outperforms. I think the regime that we're in now is falling inflation, or at least decelerating inflation and decelerating growth. And that's actually the best place to be for fixed income. So the heads up that I can give you is I'm thinking quite hard about, for my next monthly at the beginning of February, moving some of my money out of cash into government bonds. Now, part of the problem is the market started anticipating this a little bit in advance. And we've seen bond yields come down today to 3.2, 3.3%. But I think in a recession, it's going to go a lot further down than that. So on the 12-month time horizon, I think US Treasuries is probably where I would be at the moment. The other place I would certainly be looking at being in probably a slightly longer term environment are commodities. In the short run, they are very dependent on China. When I talk about commodities, it can either be buying an ETF on the commodity index itself, or buying the mining stocks. And again, you can do that through an ETF. I'm sure that Planning Alternatives can find ways for you to get access to that. In the short run, there are some issues here. So I showed you earlier that Chinese credit stimulus is the black line on here, little bit running out of steam. And commodity prices do tend to be quite correlated with that, with a lag of about 9 months or so. But I think that because of the energy transition we're in the longer run, on the 1 to 3 year time horizon, commodities do look quite interesting at the moment. And if you look at the performance of commodity prices in history, and this chart goes back to 1900, you can see that we typically have super cycles. So it happened in the 70s. It happened when China joined the WTO in 2001. And in these commodity super cycles, you usually see industrial metals prices going up 3 to 4 times. And it happens over a period of 10 years. What's causing the current, what we think is probably a super cycle, is the energy transition. So if you take a metal like copper, for example, electric vehicles use 4.5 to 6 times more copper than a conventional combustion engine car does. If you think about wind turbines, they use a lot of metals as well. So I think we're quite likely in a commodity super cycle. Any weakness in commodity prices is something that I would be looking to buy. Maybe the third area I would look at would be emerging markets. Now, if we're looking at perhaps some sort of rebound in China, the places that should benefit would be emerging markets. Now, we at BCA Research historically in the last 10, 12 years been quite bearish on EM, which was the right thing to be. They didn't perform well. But I think there are some signs coming through that the fundamentals in emerging markets are looking better. And when you look at EM, I would really separate the China story from the rest of emerging markets. If you look at the return on equity, so the profitability of companies in all these markets, If you look at China, which is that sort of dotted gray line, you can see a very significant decline in profitability over the past 10 years or so. If you divide that down into private sector companies in China and public sector companies, you can imagine the answer, which is the private sector companies have had good ROE. China's done a very good job at creating internet companies, these names such as Tencent and Alibaba, which are internationally known. But the state sector has been a disaster, and the weighting of the state sector has gone up. Xi Jinping's key belief is that the government runs things better than the private sector does. And the direction of policy in China is to say that we need to have more state control of the economy. Those internet companies had last week to sell a controlling stake to the government. They've essentially been nationalized. But if you look at EMX China, the red line, you can see that for the first time in 15 years, the profitability is now actually as good as the US. And I think one of the reasons for that at the moment is that the developed market central banks, like the Fed, misread inflation. In 2021, they bought this narrative that inflation was transitory, don't worry, it'll be gone away within 6 months. The EM central banks were not fooled by that. They have a much longer experience of inflation. They were raising rates. Brazil, for example, raised rates from 2% in 2021 to 14%. And you can see the black line on the right-hand side, emerging market, so Brazilian inflation has come down quite a long way. So I'm only a neutral on EM at the moment, but I do think it's potentially in the long run. You're talking here about countries like India, the semiconductor producers like Taiwan and Korea. You're talking about some of the Southeast Asian countries like Thailand and Malaysia, etc. I think in the long run, those look relatively interesting as well.
Thank you, Gary. Hopefully today, as you've listened to Gary's excellent presentation, you've gotten a lot of insight around issues going on in the world. It can be unsettling when you hear all these things that are transpiring, but the world continues to move at a rapid pace, and it's important to be aware of the issues. And we want you to know that we work closely with Garry and his team to focus on best practices to navigate these types of environments. So one of the things that we've been doing over the last few quarters is really talking about how can we make the most of your funds, and we've focused on increasing yields and looking at things like individual bonds or treasuries, or making sure that your money is working hard in rising yield rates in money market funds. So just as a tip, if you have money in your bank account or some sort of account, double check the yield, because often we find that banks are not paying very attractive rates when we can help you get a much more attractive yield rate in this type of environment. Even CDs that seems like for the last couple of decades, they were at an incredibly low rate. They are very attractive. So we build what are called ladders, sequenced time periods of holding a CD or a bond to various lengths of maturity. We also want to encourage you to reach out to your advisory team and advisor to revisit these conversations, these topics that we're having today. There's many things that have gone on in the financial world around legislative changes. So at the end of December, the Secure Act 2.0 is a 4,000 plus page document that was passed at the end of 2022. And you know what happens when 4,000 page documents get passed by Congress? It takes a long time to figure out what they actually said. So there's implications to retirees, to retirement savings plans, to a lot of things that can affect you as an investor. And we sift through this information so that when we speak with you, we're on point with how we can meet your needs. I also want to share a slide that many of you have seen in meetings with your advisor. And this is, we call it the diversification quilt. And it's the various color charts of different types of investments. And this goes back to 2008. And every year they're ranked from highest to lowest return. And it's impossible to predict which investment is going to be the best or the worst. And that is why we employ, through Garry and his team's guidance, a asset allocation where we're taking different segments and of your investments and combining them together. And this like light gray box is really you can see it connected by the dotted lines here. That's how we hug the middle. As we build your financial plan, we're trying to deal with a very uncertain environment, but create more predictable outcomes, and having a highly diversified strategy that is in tune with what are the trends going on and how do we take advantage and make some tilts or shifts as appropriate is important. And one of the recent tilts that we shifted is that we went to an ex-China emerging markets fund within the portfolio. So that confirms some of the things that Garry had discussed. So I'm going to wrap up with a couple of questions that have come in. The debt ceiling is an issue in the US. What's your take on the significance of that and any remedy?
Yeah, I mean, it's obviously scary. I think when the Treasury is now taking various remedial actions, but they will run out in June. So, can we actually have some agreement in Congress to raise the debt ceiling? I mean, the US is the only country in the world that has this concept of a debt ceiling. It's completely illogical, because if Congress has voted for a certain budget, they have to vote for the debt to fund that budget. There was one time, I forget when it was now, was it the early 2000s, when they did miss it briefly. It's such a nuclear button that I don't think that they will press it. But it clearly is an issue. And I'd probably broaden it out to say that US has now government debt to GDP the highest it's been since 1946. And if you look at, with the rise in interest rates, the cost of funding that debt is going to treble if you look at the Congressional Budget Office estimates. And that's going to cause quite a lot of problems. I mean, the budget deficit is going to be growing every year just in terms of paying the interest on that debt. So the broader issue there is that this might in the end turn up to be inflationary, that maybe at some point, not this year, but in 2 or 3 years' time, the Fed will say, look, we can't keep on raising rates because it's going to be really bad for the fiscal situation. The same thing happened after World War II, where the Fed actually agreed to cap 10-year Treasury yields at 2.25% until about 1951. And if they do that, it would be inflation. It's one of the reasons why we do think that inflation is going to be a longer term problem than just last year, which is why, and I'm sure something that planning alternatives look at is inflation proofing your portfolio. Thinking about the real value of your assets is particularly important at the moment.
Thank you. And then the final question, Garry, has to do with politics, which is always a big topic in the US. Can you quickly comment on any interrelatedness between politics and the financial markets? Because some people think they are completely connected. Some people view them as disconnected. What's your take?
Yeah, in the normal run of things, they don't have much, politics doesn't have much of an impact on markets. And the situation we have currently with the three arms of government in the hands of different parties, so this sort of stalemate is actually good for markets. When the government can't do anything, markets typically likes that. I mean, the risk is going to be the 2024 presidential election. Is Donald Trump going to be able to get the Republican nomination? I mean, his popularity has gone down. DeSantis has gone up. If it were to be Donald Trump, I suspect that the markets would be a little bit worried about that. But I mean, the key risk is, do we get some disputed election? The 2020 election was not close enough that it could really be disputed. And maybe some people on the call wouldn't agree with that, but I mean, it wasn't in the end that close. If we had it more like 2000, and it's genuinely down to a few hanging chavs, what they called, and it has to go to the Supreme Court, and we get to January and we still don't know who the next president's going to be, markets would be very scared about that. And I think, if it looks going into 2024 that is a realistic scenario, it's something the markets would start to price in and get nervous about. But for now, it's not a bad time to be. And it's worth saying actually that the best year in the presidential cycle for equity returns is actually the year that we're in now, year 3. An obvious reason that the president, particularly if it's a president who's going to be able to restand, wants the economy in a good shape. And I think the best bet for for Biden and the Democrats is that the economy has a recession the first half of this year. It's a mild recession, which I think it probably will be. And we come out next year looking really rather healthy. And by November 2024, the economy's back in an expansion again. But yeah, it could be, if it looks any risk of a disputed election, that could be a problem.
Garry, I want to thank you for joining us today. Appreciate your insight. Obviously, you are well-versed with your team and well-equipped with your team to analyze a lot of various issues, very complex issues, but synthesize them into a meaningful strategy. So we're grateful for our partnership with you and BCA Research. And I want to thank you for joining us today. I also want to thank everyone for attending. We'll be wrapping up our webinar now. We will have Garry's presentation available if you're interested. And for those of you who are in the Eastern time zone, it's lunchtime. Want to wish you a great lunch, and for everyone, a great rest of the day. And we'll look forward to seeing you soon.